Inflation numbers for August came in better than expected, dropping down to 2.2%. Mortgage rates hit their lowest level in 2 years this week, with the average 30-year mortgage rate dropping to 6.08%. This, of course, after the Fed lowered interest rates for the first time in 3 years. Now, despite those positive numbers, auto loan debt has now overtaken student loans as the second highest household debt in America, with only mortgages out costing consumers. This comes as Americans are facing sticker shock, with new cars averaging a whopping $47,000. That's on average. Here with us is automotive expert and the founder of the Car Coach Reports, Lauren Fix. Lauren, good morning. So with car payments now being one of the most expensive debts hanging over Americans, how does paying a little bit more than your minimum payment help you stay ahead of this debt?
It helps a lot, actually. If you can just add $100, I know it's a lot, especially in today's economy, but if you could add a little bit more to your payment, even if it's $50, it would help lower your payment. And that will really help you in the end. What you're doing is you're lowering your interest rates. Another thing you can do is refinance. Let's say you've got a 5-year loan and you've paid 3 years into it. And you're like, wow, I don't know how I'm going to make these payments. You can refinance it for 3 years. Don't go back to 5 years unless you're planning on keeping that vehicle and it's in great shape. But that's what some people do in order to lower the payment, because obviously with the cost of everything getting more expensive, you have to kind of figure out where you can save a few dollars here and there.
And with more and more people finding themselves overwhelmed with these car payments, how can lenders help people tackle this mounting debt? Any other advice that you would offer?
Absolutely. If you're thinking I've got a loan through one of the car manufacturers, I highly recommend looking at a credit union. They're really great at consolidation loans. They're also good at helping you get a lower interest rate. So maybe you've got a 5-year loan on a car or a 3-year loan on a car, and you've got a certain amount left. You could get a lower interest rate since rates are just a little softer right now. It'll also allow you to make your payments a little smaller. And also when you buy a new car, put an extra $1,000 down. It'll save you about $20 a month. So if you're looking at a lease or you're looking at a purchase, those are certainly factors. While keeping your car longer makes more sense than just getting rid of it every 3 years.
Good advice. With the Fed lowering rates, does this present a better opportunity for people to refinance their loan? And if so, how?
Well, it does and it doesn't. I mean, the problem is it's a little softer, but not enough to make a dramatic difference. You have to be careful you don't make yourself in an upside down situation. What does that mean? That you owe more on the car than it's worth. And that happens a lot. And then if you go to the dealer and you say, oh, I got to get rid of this car, I need a minivan or a truck or an SUV, whatever it is you need, they'll roll that extra money into the next car payment. That is the worst thing you can do, because you'll be paying for that car in the new car. So you want to make sure that if you're going to refinance, that you stick with the vehicle you have, which means it's your responsibility to maintain that car, basic maintenance, batteries, brakes, all the fluids in your car. Even if it's an electric car, you have to plan to keep that car longer to get the most value from that vehicle.
Lauren, how does growing auto loan debt impact someone's credit?
Oh, it's huge. It used to be it wasn't as much of an impact. When your credit rating impacts a lot of things, it also impacts your insurance rates. So when you think, oh, I'm going to get my new policy, interest rates are slightly lower. This might be great. But think about insurance. The average rates are up between 50 and 55%. And that's a lot. And part of that is because of data collection, but it's also cost of replacing cars. If you have an electric vehicle and it's in a fender bender, typically the insurance company will total the car. They don't want to take a risk of your car catching fire or something that a collision shop can't see in order to repair. So the costs are too high. So that means the cost of the average repair and parts, because we went through all that part shortage, and it could get worse October 1st. If we have a port strike, it's going to get really ugly. You're going to watch insurance rates get even higher. So keep in mind that you've got to calculate all of that in, and your credit rating impacts not just getting a loan, but also your insurance rates.
Yeah, a lot of factors to consider here. Lauren Fix, thanks for joining us.